Another day, another dollar. That's how we are going about our lives. We continue to push and go forward. And here we are, another day, another video. So it's been a crazy time for us. Crazy time for us. We've been fundamentally bearish. And we're going to keep today's video focused on the fundamentals. It's a very noisy market. Right now, it's particularly volatile and all over the place. However, this is a very strange market. And while for the past couple months, I've thought this is the greatest divergence ever between what the market is pricing from the Fed and what the Fed is actually going to do, it seems today there's a little bit of reconciliation on that. And the propensity to fight the Fed, while still one of the greatest amounts ever, is today starting to back out because we are yet again getting hawkish data. And we've got plenty to talk about. The St. Louis Fed was making some good Twitter posts over the weekend, which I want to highlight and discuss here. And we'll get into that now. So James Bullard, has talked several times about this Dallas Fed trimmed mean. And why do they want to trim these means? Why do they want to trim inflation? Why can't they just look at CPI? Well, there's a few categories which are incredibly volatile and aren't necessarily affected by monetary policy, like food and energy. We're going to have to consume roughly the same amount of food and energy regardless of what happens in the economy. Yes, in a recession, a hardcore recession, people eat slightly less filet mignons. That's true. They eat slightly less. You want to make it more broad? They eat slightly less meat overall. They eat slightly less red meat, slightly less chicken. They eat more rice and beans. That's what happens in a recession. It does occur. But overall, the propensity to consume food is there regardless. There's a demand for food. There's a supply for food. Certain categories might change, but others might benefit. Overall, food gets consumed, but prices fluctuate all the time, and they're not necessarily affected by monetary policy. Similarly, energy gets consumed. Yes, on the margin, a slight amount of energy consumption might go down. There might be slightly less shipping and travel. That is true. That occurs. And we'll get into energy later in this video, but I want to first talk about inflation, highlight why they strip those categories out. So they put out the Dallas Fed mean, and I'm going to make that the thumbnail for this video. So go look at the thumbnail. It is flat. It is not moving. The Fed will not, in my opinion, truly pause until they see that budge. And we just got some data on Friday, and it was hotter than expected. So that just simply isn't moving. It's the same read for March as it was in February. Who knows what it's going to be in April? April seems to have been a pretty hot month. Saturday was the highest gasoline consumption Saturday since the Saturday before Christmas, which is obviously shopping season. People driving to malls and whatnot, doing all that driving. So it seems that things have been okay in April. And now let's talk about the market's expectations. Well, after SVB failed, yields fell tremendously. The fall in yields allowed tech to rise tremendously. And bull spirits to get bulled up. Bitcoin went above 30,000, et cetera, et cetera, et cetera. Again, we're seeing that reconciliation today. But part of that fall in yields that allowed everything to get so disconnected was this notion that the Fed was going to be afraid of financial stress. If you were watching the videos after the last FOMC meeting, you'll remember we talked about how James Bullard talked about how, yes, financial stress did tick up after SVB, but historically it was relatively light and not too much of a concern. It was above zero. Well, guess what? Now it's back below zero. So we are above or below the average financial stress situation. So we've got sticky inflation. We've got aggressively receding financial stress. We've got very high Saturday gasoline consumption. The picture is not pointing to a need to have rate cuts. I'm not talking about additional rate increases, okay? I'm going to be defensive. I've had a rough year. I'm going to be defensive based on what I see fundamentally. I'm still aggressively a bear at this point. That's just the way it is. I agree with the people who say we had the most speculative bubble of all time, pretty much. That's Charlie Munger. That's Michael Burry. It's not, Crypto Bro 69 Doge poopy butt or whatever. That's not the person I'm listening to. I'm listening to Charlie Munger, Michael Burry, legends who have bet against the consensus and been right. Anyways, there's not a screaming need for the Fed to cut. There's not. GDP was positive in Q1. We're not in a recession yet. I do expect slowdown. But you heard Powell. He said a recession is just as likely as a slowdown. The Fed is hiking rates to slow down the economy and bring supply and demand into balance. So, yes, there was financial stress, but it's contained. It's not, or it's lowered. It's below zero, okay? I get it. People want to, particularly capital owners, salespeople, and company owners that benefit from lower rates, they're freaked out about the situation, of course. But for once, the government has decided to do something that actually impacts the lowest income people the least, which is hiking interest rates. They're not really going to be affected by this. The lowest income people, they're not buying houses all the time. They're not buying cars all the time. They're already getting, when they buy a car, they already pay 20% interest. This isn't going to affect them, okay? It's not a matter of 3 or 5% on a $1 million super yacht or whatever, okay? It's not that type of situation. It's not going to affect these people. What it is going to do is it's going to slow down inflation and increase their purchasing power, which is exactly what they need. So the Fed, in my opinion, is steadfast in this. However, the market expects several rate cuts by year end. The most likely outcome, I believe, is actually for 3 rate cuts at some 40% probability, because the market is pricing in more likely than not by a good margin rate hike in May. Then obviously more likely than not pause in June, but I believe 4.5 to 4.75, that's like 2 rate cuts this year at least. And then there's significant probability of more rate cuts than that. So the last I checked, there was only a 4.8% probability that the Fed does what it's going to do. In my opinion, there's a 95% probability that the Fed does what it says it's going to do. Actually, it's probably less than that, probably 80%, because there's probably a 15% probability they do a June hike. I'd say that's a reasonable probability, given that today we got expanding, okay, above 50 is an expanding read on ISM prices paid. We had hotter than expected PCE or core PCE rather, and maybe PCE, but I don't care what PCE is. I only care about core PCE because that's what the Fed cares about. And core inflation, it came in at expectations. It isn't really cooling off. So inflation is staying level. It's staying high. I don't think the Fed is going to be ready to really pause and take away the notions of additional policy firming may be required until core inflation. I'm going to broadly categorize that as core CPI, core PCE, and Dallas trim mean breaks 4%. I think once it breaks 4%, then they'll feel like, okay, we're in the 3s, we can pause. Because now we're just in the 3s, we've only got to go 50% down in terms of inflation and get it down from 3.9 to 2. They're not going to be done until they get to 2. Now, if it gets to 3.5 and it's sometime next year and it's on a clearly downward path, yeah, they might do the first rate cut because inflation is lower. When inflation is lower, you don't need rates to be as high. But right now, core inflation isn't moving. It's 4.5. The 10 years below that. A lot of rates are below that. So the 2 years below that. So one could argue rates are still negative in real terms. They're not sufficiently restrictive. That's what the Fed's trying to figure out. So far, it hasn't broken the flat line. So is it sufficiently restrictive? I don't know. All I know is my inclination is for them to lean more in the hawkish direction versus the market's dovish direction. And hawkish direction doesn't necessarily mean more rate hikes. Talking about additional policy might be required. Saying maybe 50 this time. That's not what hawkish is. Hawkish just means wanting to tighten. not wanting to cut, doing things that are a little bit more restrictive or QT-esque than what the market is pricing in. And that's my assumption. That's what I think the Fed is going to do based on all the facts and fundamentals I've just laid out for you. You can make your decision. You can ask me questions. Feel free to debate me in the comments. I'd love to fine-tune my sword. Anyways, that's enough with rate outlooks. I obviously translate that into tech stocks. I get it today. They're not breaking to that, but T-minus how long? I don't know. We'll find out because they're going to have to do it. They can't benefit from the fall in rates and then not suffer from the rise in rates. It doesn't go both ways, or it doesn't go only one way. It does go both ways. Anyways, I want to talk about energy. We've been at this level for quite some time. It's brutal, but if you look at inventories, 1 or 2 inventories is definitely not something to look at, but many inventories certainly is. OPEC is cut. Prices are level here with SPR releases having occurred during this period of time. There's obviously a hypothetical SPR floor. I don't think prices are going to go much lower. So I see a lot of these stocks trading in single-digit multiples, paying good dividends. I see a supply and demand deficit being in place. We're getting into driving season, heavy oil consumption season. I think, this is the time for oil to start rising. Right around now, maybe a little earlier than right around now. Last year was when that move really started to pick up into June, and then they had to do hardcore SPR releases. The average decline in the price of oil during a recession is roughly 30%. We've experienced possibly even more than that. So I think it's a good time to begin a recovery. I see more upside than downside. So I think it's a good risk-reward situation. And, there's a phrase, don't bet the house. But as much as I don't like George Soros and the way he goes about his politics and doing all that George Soros questionable stuff, he is one of the best hedge fund managers, asset allocators of all time. And you know what he said? When the odds are in your favor, you do bet the house. And I feel like I've done that sometimes. And I get it. I'm down big this year. No question about that. But I think he's right. When the odds are in your favor, you got to go. And I think the odds are very much in our favor in these two areas, both betting against the tech market in particular that have gone extreme and are trading near all-time highs and are seeing earnings decline in many instances. And especially not be at the growth rates that you would have if you had this kind of multiple, right? There are companies that have higher growth and lower multiples than them. That is a thing, okay? ExxonMobil, it's been around over 100 years. Didn't start out as an oil company. They're not going away tomorrow. They're growing more than Apple, and they've got about somewhere between a half and a third the multiple, something like that. So, yeah, there's other places to go. It's not just about Apple, in my opinion. So, we'll see what happens. That's today's video. We're starting to see some reconciliation. We're seeing hefty moves in bonds, but it's a single day, and we need several weeks of this. So, that's today's video. We'll see what happens. Until next time, peace out.